Welcome to Geopolitics Day. We're going to spend the next 3 hours looking at superpower competition and how that competition is playing out in various domains. Supply chains, technology, and capital markets. The conversation could hardly be more timely. We're just a few days away from COP26, where I think we saw the first tentative signs of US-China warming. And evidence of that was the agreement that John Kerry worked out with a man he called his good friend of 20 years, China's chief climate negotiator, Xie Zhanhua. And then, of course, on Monday, we had yet another virtual summit between Joe Biden and Chinese President Xi Jinping. So a couple of housekeeping notes. We're going to power through this morning. We're not going to have a coffee break. So if you feel the need for a caffeine fix or anything else, feel free to wander out at any time. Of course, if you wander out, we would prefer that you wandered back. The other thing is that we want this whole session to be super interactive. So not just questions, we're also interested in what you have to say, in statements. No iPads today. Today is microphone. So if you have a question or you have a statement, please put up your hand and we'll bring you a microphone. I think that's it on housekeeping. So we're going to set the stage with a Bloomberg data presentation. What else? Tom Orlik is our chief economist, and Tom and his team have put together a data presentation looking at risks to global trade through two prisms, US-China competition, and also through climate. So let me hand you over to Tom.
China, carbon, the future of global trade, these are weighty topics that we could spend an entire conference discussing. So I'm flattered that in the confidence that the New Economy Forum has placed in me, probably incorrectly, in assuming that I can do justice to them in 8 scant minutes. I'll do my best not to disappoint. So, at Bloomberg Economics, our starting point for thinking about the future of global trade has been a big data-driven analysis. We trawled data across 4 decades and hundreds of countries, and we looked at the factors which make some countries, like a Singapore or a China, succeed in the global system, and the factors which confine other countries to isolation and autarky. And the results are clear. Cheap labor helps countries succeed in exporting. R&D spending, the capacity to innovate, helps countries succeed in exporting. Good logistics, political stability, and proximity to market are all drivers of export success. Now, taking the results of that analysis and combining it with our long-term forecasts for GDP growth and other factors, we can paint a picture of what the global trade system and country shares in the global trade system will look like in the decade ahead. And these pie charts are telling you the story. Now, there's going to be some differences in our baseline forecast between country shares in global exports in 2030 and country shares today. China is going to play a larger role, the consequence of the gravitational pull of China's huge domestic market. But the bigger takeaway when I look at these pie charts is that on a plausible base case for the decade ahead, country shares of global exports in 2030 are going to look pretty similar to how they look today. Well, that's the base case. But as we all know, we are at a moment in human history where predictions about the future come with a very low degree of certainty. As Henry Kissinger said on day one of this year's New Economy Forum, in that evocative phrase, we stand on a precipice where we can look forward to a constructive and collaborative global economy, or we can step over the edge into an abyss of missed opportunities. So I want to paint a picture of what stepping off the abyss might look like. In a moment, I'm going to talk about what happens if US and China relationships continue to deteriorate. And to motivate that part of the presentation, I want to ask all of you for your opinion. Where do you think US-China relations are going to be in 10 years' time? Are we heading into a new Cold War? Does the Xi-Biden summit this week provide a basis for stability? Or could relations even improve? Let us know what you think. And whilst you ponder the answers to that, I'm going to talk about another existential threat to the global economy and an existential threat to the global trading system: climate change. Now, it's clear that if the world is going to get to net zero, then we have to start putting a price on carbon. And when we put a price on carbon, we introduce a new source of comparative advantage into the global trading system. Countries and companies which are efficient in their use of carbon will have a new competitive advantage. Countries and companies which are inefficient in their use of carbon will face a new drag. And what's also clear coming out of COP26 is that the coordinated action needed to raise carbon prices together is so far not quite there. Now, that raises the possibility that first movers like the European Union, perhaps the United States, perhaps Japan, could move first, setting a high price for carbon at home and then imposing a carbon border tariff to protect their domestic firms from unfair competition. So we used a big model of the global economy to explore what that scenario would mean for global trade flows and for GDP across major economies. The conclusion, which you can see in the pink dots in this chart, is that for new economies, a world where advanced economies impose a carbon border tax is not pretty. President Putin of Russia, a man who doesn't like to lose anything, would lose around 7% of Russia's GDP. Prime Minister Modi of India, and we heard from Secretary Kerry about India's role in the COP26 negotiations. Well, if India doesn't move on carbon prices and then faces a carbon border tax set by Europe, the United States, and elsewhere, Prime Minister Modi would say goodbye to 6% of India's GDP. So for new economies, a world where there is a failure of coordination in the response to climate change and where they face carbon border taxes from advanced economies is a world where the costs are very significant. Now let's come back to the China-US question, and let's see the responses of the audience to that question. Where do you think US-China relations will be in 10 years' time? So, some optimists in the audience. A third of you think things are going to improve. But the balance of opinion is towards pessimism. A complete breakdown, 10% of you think we're going into a new Cold War. Almost half of you think that relations are going to continue to deteriorate. So we used our model of the global economy to explore what that worst-case scenario looks like. we broke the world into two competing blocks, a China bloc and a US bloc. And then we introduced tariffs into the model, which effectively turn off trade between those two competing factions. What impact does that have on GDP for the new economies? Well, it's the countries which are the biggest winners from the current global trading system, the trade surplus countries in Asia, that would be the biggest losers in a Cold War scenario where global trade is turned off. China says goodbye to 6% of GDP. The big commodity exporters which feed China's industrial engine lose out. Asian neighbors enmeshed in the same electronics supply chains lose out. And ultimately, with so many US and European firms tying their fate so closely to the continued growth of the Chinese economy, the whole world would be the loser. So, let me be clear. These are not our baseline forecasts for the global economy. These are model-driven estimates of worst-case scenarios. But the magnitude of the numbers that we're discussing, Russia losing 7% of GDP, India losing 6% of GDP, China losing 6% of GDP, these are huge numbers. And they underscore the cost to the new economies and the world if we get it wrong on climate change and US-China relations, the benefits and opportunities if we get it right, and the importance of the conversations that we're having at this year's New Economy Forum. Thank you for your attention.